Hi, my name is Nikhil. Me and my classmates Sahil, Jimin, and Jason will be presenting the financial plan for Laura and Bill, which is the case B. Let me talk about the client's profile. Laura is a 59-year-old news producer who is married since 15 years to Bill, who is 65-year-old and president of the luxury leather bags manufacturing company. Looking at their cash flow and net worth, we could revise it to transfer the expenses towards the savings for TFSA and Bill's conference. The global priorities are to analyze and assess their current financial position, to determine their current asset situation and anticipate it for the future, to check the risk management, ensure that there is an adequate life and risk tolerance and health insurance, to use tax saving strategies, to figure out how much money they will have in retirement, and to manage their estate planning affairs. Talking about the financial management recommendations according based on their ratios, we could see that the debt ratio is 0.4%. The debt ratio is the ability to meet their debt obligations. The GDSR is the amount of mortgage they can afford. Their GDSR is 14%, whereas it needs to be below for 35%. They are in a good state. TDSR evaluates current housing and other debt repayment costs. It should not exceed 40%. For Bill and Laura, it is just 7%. Saving ratio is the portion of income that one saves annually. The recommended percentage is 10%. Here, we can see that for Bill and Laura, it is 32.5%. Bill and Laura never had emergency funds. So we can have the emergency funds, and the two options that we can provide them is to use the $3,000 that is there in the checking accounts towards any unforeseen situation with selling the non-registered investment fund which had low returns over the years. The Bill's non-registered funds, GHHI and MNO Mines, have been giving him low returns. Hence, it could be an option to sell it. The second option is to open a joint TFSA account and save for the next 5 years. They will need to save $8,000 per year for the next 5 years to have 40,000, which will cover 4 months worth of their expenses. I'll give it to Sahil, who will cover the topic risk management.
Yeah, so I would be going forward to the risk management for Laura and Bill. So while accessing their risk profile, we observe that Bill is a risk taker. So it means that he likes to assume risk in his life, while Laura is a risk avoider. So she practices risk avoidance. So this would give us a clear picture while managing their risk. So talking about life insurance, since both of them don't have a life insurance plan or right now, so we suggested them to go forward with term life insurance. Before going forward to that, we calculated the life expectancy through FP Canada guidelines, and we got to assumption that Laura would be living up to 96 years, while Bill would be living up to 94 years at an expectancy of 25% rate. So both of them can go for the term life insurance, while the term for both of them would be different. Bill should be opting for a 10-year term life insurance, considering his age factor. So, and for Laura, it should be like a 20-year package, and the coverage for Bill we suggested would be 100K, and for this would cost Bill $792 per month of premium, or $9,050 a year, and this is for Laura. It would be the same insurance company that would be covering her with a coverage of 80,000. So moving forward, talking about whole life insurance. So whole life insurance provides you the insurance as for regular simple life. So it should they are like it has fixed price plan that could be charged in 10-year, 20-year, or 65-year. So for Laura and Bill, we recommended a different plan. For Laura, uh, we recommended a 400k 400k with a $8,600 a year. That would be the premium they have to pay for the coverage, and for the same coverage, Bill would have to pay a bit more. That would be $10,452 per year. Talking about the disability insurance, they uh, they should offer income protection plan under for which both of them would be paying around $410 per month. So moving forward, I would like to talk about property insurance. So property insurance, we did an assumption for the property insurance. Uh, in Ontario, the average property insurance rate for would the premium would be around $117 to under $850 uh, for a 3 million property. And talking about the automotive insurance, we didn't have a clear picture of this because we didn't have the more information provided by Laura and Bill. So to make an effective decision, we would like them to give us a provide a specific uh, model of the car, when did they purchase it, to give them a better quote for the same. So I would be moving on forward to the asset management for them. So while doing the asset management, uh, we uh, we did a certain assumptions for them. So we would suggest Laura and Bill to have a medium risk portfolio, which will allow them a better rate of return without taking severe risk, and invest in funds which wouldn't need routine management, as in they won't be required to go and forward to their assets every day. And they accessing this current situation and the portfolio, they both we recommended some of the equity and fixed income changes. And currently we think that they do have a good asset management right now. So I would be like forwarding it to Jason for the rest.
Hello. So when we looked over Laura and Bill's financial situation and goals, we noticed that they had a strong idea and vision of what they wanted to do in their lives. We wanted to identify the tax implications of what their potential future actions could cause for their financial situation if they decided to move forward with their goals. And we also wanted to help find a way to reduce their tax consequences. So for Laura, she wants to take an early retirement at age 60, but continue to work as a receptionist at her husband's company. If she moved forward with this goal, we determined that her taxable income coming from all sources would be $97,680. And her taxes payable for both provincial and federal will come to a total of $22,453. So how can we reduce Laura's tax liability? Well, we can do that by using her tax deductions and tax credits that are available to her. She'll be able to utilize the basic personal amount, the employment tax credit, RRSP contributions, and the CPP tax credit to help reduce her overall tax liability. So after applying all the deductions and credits, her new federal tax liability would be around $11,800. So if we compare it to her tax liability without the credits and deductions, she will be saving about $3,900 in taxes. So let's look at Bill now. One of Bill's major goals is to eventually sell his shares of his business to his daughter and son-in-law, as well as other investments. The main tax implication here is that there'll be a large taxable gain that will arise from the sale. So if we account for all of his possible capital gains that Bill may incur in the future when he sells all his property, he may have a taxable income of $598,400. So how could Bill reduce this? Bill can qualify for the small business corporation shares capital deduction from the description of his business. He will be able to deduct a maximum of $424,126 from his net capital gains on the shares of his business. In addition, Bill suffered a capital loss on his shares in his brother's company, and he will be able to apply this capital loss against his capital gains on his other investments. In addition, he could also use deductions and credits to further reduce his tax liability. You can use the basic personal amount, the H tax credit, RRSP contributions, and CPP tax credit. So after applying everything, Bill's new taxable income would be around $151,314, and his tax payable would be about $29,000. As you can see, there's a significant savings in tax payable, as there is a $447,000 decrease in taxable income if Bill applies everything. So our recommendations for Laura is to max out her registered accounts like her RRSP to defer any potential tax liabilities, continue investing into non-registered accounts for the dividend and capital gains tax treatments that are far more favorable compared to interest, and keep income earning investments in registered accounts and dividend or capital gain based investments in non-registered accounts. For Bill, our recommendations is to be take advantage of the small business corporation share deductions for when he sells his shares, utilize the net capital loss against any capital gains on his other investments, and maximize his RRSP contributions since he hasn't been contributing to his RRSP, so it could reduce his taxable income. And now my colleague Jibin will talk about the retirement component.
For retirement planning, the Laura's age for retirement will be 60 years old, and for Bill, and for both, the life expectancy will be 94 years old. So general assumption for retirement planning is the expense for clothing will be decreased. The expenses of entertainment and loan payment will be relocated to a medical expense. And after retirement, there will be no more income taxes, CPP, EI deduction, and RSP and non-registered saving. Also, normal rate will be 5%. Here, they need $50,000 approximately when they are retired for expense a year. So they will need $1,193,000 approximately when they are retired. For CPP, Laura, she will take the early retirement at age 60. So the value of CPP will be $270,000, and for Bill, it will be $460,000. For OAS, we assume that both of them will get roughly $7,000 per year. So for Laura, it will be $210,000, and for Bill, it will be $223,000. Also, we assume they have a defined benefit pension plan with the final average earnings for 3 years with 1.9% benefit, and the salary will be their income in the cash flow statement. For Laura, it will be $711,000 when she was retired, and for Bill, it will be $709,000 approximately. Here, RSP for leave. Laura will have $350,000. Bill will have $133,000 when both are retired. For a non-registered account, Laura will have $20,000 for equity and $66,000 for bond. Actually, he also has a non-registered account, but it's kind of commodity investing. So in this case, the value always could be appreciated or depreciated. So it depending on how the company run their business. So we are not including his non-registered account for retirement planning. So in joint checking account, they will have $1,552,000 when they're retired. And here they need $1,193,000, but in fact, they will have over $3 million. So they have a sufficient money for retirement. So Laura can start her CPP at age 60. Also, Laura still have a unused RSP room, which is $12,000. So she can fill it when she work in a Bill's company. Also, Bill still has 100,000 of a huge unused RSP room, so she could save more money there. Finally, if they want to save more money, they still have TFSA room, so they can put their money on it. Next, we'll talking about estate planning.
Thank you, Jimin. So talking about the estate planning, both Laura and Bill have different estate plans that involve different goals and desires. Laura wants to keep her cottage on her side of the family and ultimately have John, her son, acquire the cottage when she dies. However, she wants Bill to be able to enjoy the use of the cottage for the rest of his life. On the other hand, Bill wants his unregistered investment passed to his daughter. However, he wants to provide income to Laura from these investments for the rest of her life. Talking about one of the key component of a person's estate plan is their will. Without an effective will, the process becomes a lot more complicated and costly. Laura and Bill will need to create a new will because their old will was legally revoked due to their new marriage. They designated each other as the first beneficiary, and they will need to create new wills to support their new wishes and desires for their estate when they want to pass. Executors are the possible people who will make sure that the wishes in your will are properly fulfilled. Laura and John will have to find an executive for their will. The person should be someone they can trust, is knowledgeable and have regarding financial matters and have some sympathy. It's also important to know that you expect your executor to outlive you. The common disaster clause. A common disaster clause is also important to keep the common disaster clause is also important to keep in your will to add another layer of protection. If both Laura and Bill die at the same time, the clause will allow their assets to be transferred to their secondary beneficiary in timely and cost-effective manner. The trust. We recommend that they both open up a trust for their respective assets that they want to transfer to their own kids. For Bill, he could set up a spousal trust for his investment and other assets to provide income for Laura for the rest of her life. When Laura dies, the remaining trust funds would then go to his daughter. This trust will ensure that the Laura will be taken care of and this assets investments will remain in his family and not go to John. For Laura, should also create a spousal trust for her cottage. This will allow Bill to be the beneficiary of the cottage, and when he dies, the cottage will be transferred to her son. A spendthrift trust could also be used for Laura since John is suffering from an addiction right now and may not be financially responsible enough to receive the whole asset right away. The trust taxation. For the trust we mentioned, they are taxed as separate individuals and they are taxed at the same graduated tax schedule used for individuals for the first 36 months after the person's death. After the 36 months, the trust is taxed at the top marginal income tax rates. Property transferred into a spousal trust will be treated as rollover for capital gain purposes. Therefore, no capital gain has to be reported on the final return. However, spousal attribution rules will apply. That means that there will be a taxable capital gain on the trust and income every 21 years if the FMV is above ABC. Power of attorney. Laura and Bill should also appoint a POA for themselves. They should find a continuing POA for both personal care and property to ensure that all possible matters can be taken care in case they become mentally incapacitated. For property, the POA should be someone that has knowledge on the financial matters, accepting or responsibilities, and trustworthy. For personal care, the POA should be someone that you feel comfortable making personal decisions for you and can follow your instruction even if they disagree. So, our recommendations are create a new will and update it with their new goals, wishes, and desires. Find an executor that they are comfortable and confident about. Open a spousal and spendthrift trust for their assets to help with probate, tax, and security of their asset. Also, to find a POA for property and personal care. Thank you so much for your time. Have a good day. If you have any questions, let us know and we will answer the questions accordingly. Thank you.